Hello and welcome back to Money Never Sleeps. My name is Taimur from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Today, we're talking about retirement planning, but through a very specific lens. This conversation is really for people who are age 50 and older, still earning at a high level and doing what they're supposed to be doing, maxing out workplace retirement plans and taking advantage of catch-up contributions. In other words, if you've ever thought, I'm saving, but I want to make sure I'm using every opportunity available to me, this episode is for you. Throughout the first part of today's show, I'll be referencing a Kiplinger article headlined The 2026 Retirement Catch-Up Curveball, What High Earners 50 and Older Need to Know Now. And as the headline suggests, there is a curveball coming, and it's one that's catching a lot of high earners off guard. Beginning this year, the rules changed for anyone who earned more than $150,000 in 2025. If that applies to you, every dollar you allocate to catch-up contributions must go into the Roth side of your 401k, not pre-tax. This is where many people are surprised. For years, catch-up contributions have been a favorite strategy because they allowed higher earners to save additional pre-tax dollars. And for many people, that deduction made a noticeable difference on their tax return each year. Under the new rules, that upfront tax benefit on catch-up contributions may be gone. And if you're not prepared for it, this change could potentially add a few $1,000s to your 2026 tax bill. There's also an important clarification here. The income threshold is based only on wages from the sponsoring employer plan. Spousal income doesn't count, investment income doesn't count, and wages from a side hustle don't apply. This rule is very specific, but for those it does apply to, the impact can feel abrupt. Now, there is some good news. Your regular retirement contributions, up to the $24,500 limit in 2026, can still be made on a pre-tax basis. So this isn't an all-or-nothing situation. If you're 50 or older, you can still make a standard catch-up contribution of $8,000. And if you're between ages 60 and 63, a super catch-up of $11,250 is still available. What's changed is not how much you can save, but how those catch-up dollars are taxed if you're a higher earner. The bottom line is this. The upfront tax treatment just got pricier. Roth contributions come with a very different trade-off. You're paying taxes now, but qualified withdrawals later on may be tax-free. That can be appealing if you expect your tax rate to be higher in retirement or if leaving a tax-free inheritance is a priority. Historically, the key word here has been choice. Under the new rules, higher earners have reduced flexibility. If you meet the income threshold, the IRS requires that all catch-up dollars go into Roth accounts, even if you're currently in a high tax bracket and would prefer the deduction today. There's another practical layer to this as well. If your employer's retirement plan doesn't already offer a Roth option, you could be temporarily locked out of making catch-up contributions entirely until the plan is updated. The good news is that employers have been given a good faith compliance grace period through 2026, with full enforcement beginning in 2027. That gives strategies time to adapt, but for individual savers, the timeline feels much tighter. That brings us to a second Kiplinger article titled, Is 2026 Your Year to Retire? After walking through contribution limits, tax treatment, and strategy mechanics, it's important to step back and ask bigger questions, especially if you're getting close to pulling the trigger. Before joining the millions of Americans expected to retire in the coming year, you need to be confident. Retirement isn't something you want to rush into without clarity, because re-entering the workforce later on is often much harder than people expect. This is where the idea of stop or go comes into play. Paying attention to red flags and green flags can help you determine whether you're truly ready to move forward or whether it makes sense to pause and reassess. Retirement readiness isn't just about hitting a number. It's also about whether your strategy can hold up during a bad market year or a period of higher inflation. Almost everyone has a number in mind, a target they believe they need to live comfortably. A Northwestern Mutual survey puts that magic number at 126 million as of 2025, but that figure isn't universal. For some people, it may be higher. for others, lower. What matters is whether you've reached your target. If you haven't, that doesn't mean failure. It can simply be a decision point. Options like working a little longer, phased retirement, part-time work, or consulting can help close the gap. Even if you've reached your number, the next question is critical. Can your portfolio withstand a market correction? No one knows what the markets will do in 2026. While the article doesn't predict a downturn, it does note that periods of growth have historically not lasted forever. If your portfolio dropped 20%, what would that mean for your retirement? Would your strategy still work? If not, retiring too soon could mean scaling back your lifestyle or, in a worst-case scenario, returning to work. Retirement readiness isn't purely financial. There's an emotional side to this decision as well. For many people, work is tied closely to identity, purpose, and routine. Letting go isn't always easy. For others, retirement feels like a welcome next chapter. If you're truly done with the job, not done with life, just done with this job, that can be a meaningful signal. But that still leaves an important follow-up. Do you know how you'll spend your time? Retiring without a clear strategy for your days can lead to boredom and dissatisfaction. If you don't have clarity there yet, it may be worth hitting pause. The same idea applies to money. Having savings is one thing. Knowing how you'll spend them is another. Without a real income strategy, not just a spreadsheet projection, you may not be ready. The first 5 years of retirement are often the most sensitive. Knowing which accounts you'll draw from, when you'll claim Social Security, how withdrawals are taxed, and how your portfolio is positioned for inflation and market volatility all matter. Healthcare is another major box to check before leaving the workforce. A 65-year-old retiring soon is expected to spend approximately $172,500 on healthcare costs. That includes Medicare, which generally covers about 80%, but it doesn't account for emergencies or long-term care. Planning for out-of-pocket costs and testing different scenarios is essential. And if you're still unsure after working through all of this, talking through your retirement strategy with a financial services professional can be helpful. A second set of eyes can help confirm whether your strategy is built to last and resilient against inflation, market declines, and unexpected expenses. Retirement readiness isn't one decision. It's a series of confirmations that your strategy, your finances, and your expectations are aligned. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.